Hi, welcome back to Let's Talk Forex. I'm Alison, and as always, I'm joined by Chris. So today we're going to be talking about something that I guess a lot of traders have experienced.
Yeah, exactly. Abandoning a strategy too early. Yeah, and this is, as you say, it's something that's, I think, quite common. I think a lot of traders will look back with regret at some of the things they abandoned too early.
Yeah, I mean, you know the pattern. You find a strategy, it works for a little while, and it makes sense. And then suddenly, you've back tested it, and then it seems to stop working after a time, and you start hitting a losing streak.
Yeah, exactly. You'll have 2 or 3 losses, maybe more, 5 losses, and then all of a sudden that strategy that seemed so perfect now feels broken, and it leaves you not knowing what to do. Frankly, it's a real worry.
Yeah, and oftentimes, you scrap it, you jump to something new, you maybe, test a different indicator, you test a new time frame, or sometimes you abandon it completely.
Yeah, and the cycle can often repeat. You switch to a new strategy, and then the same thing happens over again. So today we're going to talk about why traders abandon strategies a bit too early, why this is so damaging, and most importantly, when it is genuinely time to walk away from a strategy.
So I guess let's start with an uncomfortable truth. Most traders don't abandon strategies because the strategy failed. They abandon strategies because they start to feel too uncomfortable.
Yes, and comfort is a really important thing, isn't it? I mean, we talk about psychology a lot, and this is another aspect of it here. You see, losses create emotional pressure, and most traders are not prepared for what a normal drawdown actually feels like.
I mean, even profitable strategies lose. In fact, some excellent strategies may have only a 40 to 50% win rate. And that means that losses aren't just occasional. They're part of the strategy. And it's something you really need to work at understanding and remembering.
Like you said, let's say your strategy has got a 45% win rate with a 1 to 2 risk reward ratio, right? So statistically in there, you could easily experience 5 or 6 losses in a row. And this doesn't mean that the strategy is broken. It just means it's probability playing out. It's just the way it is sometimes.
Yeah, but when traders experience that streak, they assume that something is wrong. And it's very natural to think that. And we all start, often you start second guessing your entries, you tweak your stop loss, you move your target, or you abandon it entirely.
And the trading community doesn't necessarily help here as well. Like if you're on social media or Telegram or everybody, someone's posting about their winning trades all day. And so if you're stuck in that social media loop, which I know that many traders are, you're going to start feeling left out, and you're going to assume that consistency means winning all the time. But it doesn't. It really doesn't.
Absolutely not. I mean, professional consistency means consistent execution, not consistent wins. And I think that's a huge distinction. And I don't think it's something that a lot of, especially beginner traders, realize.
There's also something deeper going on here as well. And this is the search for certainty.
Yeah. And, new traders often believe that there is a trading strategy that avoids discomfort, that there's a trading strategy that just works.
So every time they hit the string of losses, they think this must not be the right strategy. The right strategy wouldn't feel like this. It wouldn't make me feel like.
Yeah, but trading always involves uncertainty. Every strategy has drawdowns. Every system has market conditions where it underperforms. It's just part of trading.
Yeah, and so when you're constantly switching strategies, I mean, the main issue here is that you're never getting enough data understand which one is actually working, really working. You're interrupting the statistical process.
Yeah, and ironically, many traders abandon a strategy right before it enters that profitable streak. I've seen it so many times.
Absolutely, and this is the painful part. You endure the losses, then you quit, and then if you're just stuck with it, then that probability edge would have probably played out for you, and it would have started moving in your favor again.
So I guess the question then most people are asking is when do you decide to abandon a strategy? Because of course, as we mentioned earlier, sometimes market conditions change, and sometimes it is the right thing to do to abandon a strategy. And we're not saying that you shouldn't abandon a strategy.
Absolutely not. I mean, there are definitely times when you should abandon a strategy. The key is knowing the difference between emotional quitting and evidence-based decision making. And this is really key. So let's have a look at some situations where abandoning a strategy might actually be justified. So the first is you got to think about whether you've collected sufficient data. So you should never judge a strategy based on 5 or 10 trades. This is not a sample size. That's just randomness.
Yeah, absolutely. A reasonable strategy, what we often say is that it takes into account 50 to 100 trades, depending on your time frame. So you need enough raw data basically to assess your win rate, your average risk to reward ratio, your maximum drawdown, and then your overall expectancy.
So then, once you've got that meaningful sample size, then and if the strategy shows negative expectancy, meaning that it's losing money over time, then it is a rational time to reconsider whether you should be continuing with it.
But, of course, if your system is statistically positive and you are simply in a drawdown phase that, falls within expected parameters, then abandoning it might actually be premature. And I think that's the difficulty.
Yeah, you also have to think about whether market conditions have structurally changed. And this is something we've talked about recently on this podcast. Like you've seen since Trump's arrival in the White House, market conditions have structurally changed. And some strategies are environment dependent. So a trend following strategy is going to thrive in strong directional markets. But in arranging conditions, then it's going to struggle.
As you say, breakout strategies work very well during sort of more highly volatile periods where they perform very poorly during low volatility periods. And you've just got to understand the difference.
And if market structure shifts, for example, you get prolonged low volatility, unexpected central bank intervention, regime changes in monetary policy, then your strategy is going to need adjustment.
And the key question really becomes, is the strategy broken or is the environment temporarily unstable? And again, as you were saying earlier, Chris, it's very difficult in the current conditions, in the current regime, to really pry that apart and see what is happening. But it's very important that you do so.
And very often, the correct response isn't abandoning the strategy, it's just suspending it for a little while. Saying, look, the market conditions right now are not correct for the strategy, but when the market conditions, change again, maybe this will work. So just put it on pause, don't throw it away.
And another thing is you might realize that your strategy never had an edge in the first place. And this one is very uncomfortable. A lot of traders don't take that too well. So sometimes, you abandon a strategy because you finally test it properly and then you realize that there was no real edge to begin with, that you might have just been seeing things.
Yeah, exactly. And there's a lot of reasons for this to be, hindsight bias. Maybe it was perfect fitted. Maybe you were cherry picking and it looked amazing in those examples. But yeah, there's a lot of reasons why this can happen. But you are right. It is distinctly uncomfortable to make that realization.
So basically, if you find that proper back testing and proper forward testing doesn't prove a statistical advantage, then abandoning your strategy, wouldn't be a failure. It would actually be progress in this scenario.
Yeah, you're saving yourself a lot of money and heartache. That's definitely progress. We also need to think about whether your strategy fits your personality or not, and this is often overlooked. So a strategy might be statistically sound, might be completely correct, might be perfect, but psychologically, it's going to be too uncomfortable for you. It's going to be unbearable for you to follow through with.
Yeah. So, for example, something we often talk about is, scalping requires intense focus. It requires very quick decision making, while swing trading requires, a lot of patience and tolerance for overnight risk. And sometimes your personality, doesn't suit one, but suits the other.
Yeah, exactly. Just like we were talking with Caroline last week, on Trading Angel, she's a scalper and she has the mental resilience to follow that through, but many traders don't. So you really need to consider that. And conversely, if you're constantly interfering in your trades because holding them is making you anxious, then, you need to rethink, is this strategy that I'm following, is that really right for me? Because that mismatch is, that's going to lose you money in the long run.
So in that case, adapting your strategy to fit your personality, it really is reasonable and it is the right response. So what questions do you need to ask before you quit or abandon your strategy? Firstly, you want to ask, have I taken enough trades to evaluate this properly? I think that's that's a key question. 2, is this drawdown within historical norms? because what you find is the market repeats itself. So the drawdowns can be quite predictable, actually. Number 3, am I following the strategy exactly as designed? A lot of traders veer from their strategy and then think the strategy is not working, but they're actually not following it they'd written down in the first place. Then 4, have market conditions fundamentally shifted? As we mentioned, during Trump's reign now, markets have been particularly volatile. And this was different to, 4 years ago. So you've really got to look at what's changed in the market environment. And number 5, is my emotional discomfort influencing this decision? In other words, does my personality fit my trading style?
Exactly. And if you can't answer these questions objectively, then you're probably reacting emotionally. And you need to second guess yourself.
Then you also want to ask yourself, what is the cost of constantly changing and switching trading strategies?
You're never going to build a mastery if you're always changing strategy. And again, talking about our conversation with Caroline last week, how important it is for a trader to develop mastery. So trading success is very often, it's not the strategy, but it's how well you execute it over time.
Absolutely. And every time you switch, you basically reset your learning curve, and you kind of start all over again and have to go through the same process.
Yeah, and worse, you begin to lose trust in yourself, right? You're constantly looking over your shoulder and constantly thinking, I screwed up last time. Am I going to screw up this time? And that lack of trust in yourself will lead to hesitation. And hesitation is also a destroyer of consistency.
Absolutely. So what is the balanced solution then?
Yeah, so you need to commit to structured testing here. So backtest thoroughly. You want to forward test in a demo or a small position size. Make sure that it's that the backtest and the forward testing are consistent. You want to define your performance metrics before you start and decide in advance what is going to invalidate your strategy. So you take the emotion out of it.
And that last point is absolutely critical. You want to define your failure criteria before you go trading in a live environment. For example, if the strategy shows negative expectancy after 100 trades, for example, I will review or retire it.
Like I said, you need to take that emotion out of the decision, especially if you're, looking at a string of losses and you're considering whether to abandon your strategy or not. I mean, you're going to make an emotional decision because you've just made a string of losses. And you really, really don't. You want to have that decision removed and play it into a more rational time for yourself.
So abandoning a strategy too early is usually not about poor methodology. It's often about emotional discomfort and I guess also unrealistic expectations.
But refusing to abandon the strategy that clearly lacks an edge is also very dangerous.
So the solution is discipline, data, and extreme self-awareness.
Yes, and the awareness that trading is probability game. Start statistics here. You are not going to win every time. Losses are not a proof of failure. They are part of your trading. They should be part of your constant cycle of trading that you're in.
So if you want to take anything away from this episode, let it be this. Judge your strategy on evidence, not on emotion.
And give probability time to work. Don't make assumptions.
So that's it for this week's episode. Thank you so much for joining us. If you enjoyed this episode, please give it a thumbs up. And please remember to subscribe if you're not already subscribed to the channel. And we'll see you next week.